Welcome to the Institute's Leading Edge, a show dedicated to helping the automotive aftermarket service industry. Covering topics suggested by you, the listener, we dive into what's important, getting you what you need to succeed.
Welcome to the Leading Edge. This is episode number 84, and today we're going to talk about research and development tax credits, which is an interesting subject. Today we have with us Richard Toral from Business Group Resources, who I met about 2 weeks ago. And I think we have something that's very, very interesting and viable for the automotive industry. Richard, could you just take a moment and kind of give us the outline of what that is?
Sure.
Why is this important? How could this benefit an automotive shop?
Well, bottom line to what it does, Cecil, is it actually brings cash into the pockets of the owners of the auto repair companies. This is literally money that comes from the government, not because they're giving a handout, but because you are entitled to take advantage of a law that's been on the books for 40 years now, but small to mid-sized businesses simply haven't been able to take advantage of it. So let me give you a little background on that so I can give you some context. Like I said, this is something that's been around for 40 years, literally 40 years this year. Started in 1981 under the Reagan administration, and it was supposed to be what it was and still is, was a program to encourage businesses, American businesses, to be more efficient, to be more effective, to do things better, to be innovative, to make more profits, to do better. But for the first 25 years of the R&D credits, literally from 81 through the early 2000s, this was a program which was really kind of exclusive to big C corporations, big companies that had big CPA firms. They had the Deloitte and Touche and BDOs and Moss Adamses of the world, who have floors of people who do nothing but this for big companies. What the IRS tells us today is that even today, now 40 years later, that large companies, 60 to 70% of all large companies take advantage of this, but only 5% of small to mid-sized companies take advantage of it, simply because they usually don't know it exists. They're usually doing what all of us do in the business, is we are worried about building our widget or fixing our car, as opposed to having that kind of detailed, specific information that allows us to take advantage of it. So there are credits that are out there. The government literally pays about $14 billion a year out in this program. Our company was started in 2004 with the very specific goal of working with small to mid-sized businesses, because it's an untapped market. They don't have the specifics. We do not replace your CPA. What we do is the niche work of identifying and recovering the R&D credits. I give you an overview?
Yes, it does. I think what we need to talk about and clarify is, how does an automotive shop have R&D credits? It seems like nothing I do is R&D. So why in the hell would the government give me tax credits? Because I don't know, right?
Yep. Well, Cecil, you're bang on. There are three fundamental questions that every shop owner needs to address and understand. And these are the three biggies that we have to go through. First number question: is this for real? Honest? You're going to give me money? Okay. That's what we'll be talking about, and where the validity of that. Second question is, why hasn't my CPA told me about this? If it's out there, why don't I already know about it? And third question is, am I going to get audited? Right? Yeah. I mean, that's what we've got. You've got to be concerned about that. You've got to be aware of the issues, and I want to be able to address those specifics. But,
so if I like my CPA, don't get me wrong, and my CPA does a great job of doing my taxes, making sure they're done on time, making sure I'm paying my fair share, et cetera, et cetera. But if we filled the box with all the things the CPA doesn't know, the box would be pretty overflowing, I think.
You're right. I mean, there are over 70,000 pages in the Internal Revenue Code. Nobody can be a specialist in everything. My goodness, Cecil, your people, our people. I mean, you guys specialize in Mercedes-Benz or BMW or a Toyota or one of the others because you specialize. Same thing in this particular industry. Your CPA probably does a wonderful job. We cooperate with a lot of CPAs. A lot of CPAs bring us into their clients because we do this specialty work that they don't typically do. It requires software, it requires expertise, it requires a lot of time to do. There's a fundamental difference between what a CPA does and what we do. A CPA, your tax preparer CPA, or just tax preparer, which is the case, is typically looking at dollars. They're looking at how much money do you bring in, how much money do you spend out, what can you expense, what can you deduct as a business expense, what can't you, to try to get you, and if they're doing additional things, they might be worrying about your pension plan or your processing for the future, that type of thing. They're wonderful people that do exactly that. Our focus is not necessarily the cash in, cash out. Our focus is the activities. What the R&D credits focus on, what the IRS says is that if you as a company do these specific types of activities, which are called QRAs, qualified research activities, and a researcher does not have to have a white coat and pour chemicals into a beaker. Research is a very, very broad subject. Basically, is whatever you are doing within your organization to improve your process, improve your practice, make more profitability, get yourself trained. Cecil, the stuff that you provide for your people, that is all improvement process that you're looking at. So again, you have talking about the CPA. I'm sure every one of your shop owners has an attorney. And he has a corporate attorney who helps him with anything involved with his corporation. But if you have an accident, you're probably going to go get a PI attorney. Divorce attorneys are specialized. Real estate attorneys are specialized, right?
Contract attorneys.
Whatever it might be. Your doctor, okay? Your doctor. You're not going to have your internal medicine guy do your brain surgery because we specialize. Same thing here. Your CPA, I'm sure, doesn't do public accounting. Probably doesn't do nonprofit accounting, probably doesn't do public entity accounting like cities and things like that, because those are very specialized fields. He does corporate accounting. We do R&D. We don't do the rest of the stuff.
So every once in a while, I've been in the industry about 40 years, and I can think of at least twice where somebody thought up this crazy idea to help shop owners save money. One of the things that I remember was leasing your technicians' tools, and that would save you on workers' comp and employee taxes and all the other stuff. I didn't do it because I thought it sounded too risky for me, which is interesting because I'm like a high risk individual. But I know shops that did it, and then 4 years later, the IRS said, whoa, this is not something that you can do, and went backwards. And these guys ended up paying a bunch of extra money to the IRS because they did something that wasn't. Why is this not that?
Because it's 40 years old. We've been in business for 17 years doing the same thing over and over again. We've done it with 5,000 successful clients. We are today recovering between $3 and $4 million a month for our clients, all with small to mid-sized companies. Our average recovery is in the $60,000, $70,000, $80,000 range, depending on a company.
So I'm going to interrupt you because you're able to go back 3 years.
Yes.
So, and then you're able to move forward every year.
Correct.
Okay.
Yeah, and that is a big deal, because when you talk about it, the IRS has what they refer to as a statute of limitations, and that goes backwards for 3 years. They give us taxpayers the right to go backwards and question taxes that happened within the last 3 years. Those are referred to as the open years. Okay, the IRS has the same structure on their side, where they do not go back past 3 years with their statute of limitations, because they don't leave it open unless it's a fraud situation. There are specifics. This is not a fraud. We are making an application. We'll end up going into that detail.
So let me see if I understand this correctly. There may be and probably are certain actions that I do in my automotive business that qualify me for IRS research and development tax credits.
Yep.
If we can identify those actions that we do,
QRAs,
and then decide, what percentage of my time is spent with those actions, I could write off part or all of my salary, part or all of someone else's salary, and even some of the equipment or things that we might have purchased to get those things done.
I want to clarify one word that you used in there, and that's write-off. And that's write-off.
Well, yeah. So I'm going to,
Right.
it's not a write-off. It's a credit. Write-off. It's even better.
That's right. This is a dollar per dollar recovery, avoidance, or non-payment.
So let's say that let's say that I make $100,000 a year. All right. And we look at what I do, because I'm like writing business plans for owners, etc. I'm developing plans to help them fix their businesses, blah, blah, blah.
Yep.
Right. And I spend 20% of my time doing that. Technically, we could come up with $20,000 worth of tax credits, one for one.
No.
Okay.
No. What we do is we take 20%, let's using 20% of your time.
Right.
We can take 20% of your time as a QR of your activity. That has to be applied. This is where the magic of what we do is. What the process is that I work with a shop owner, and I've done many of them. I'm sure we'll talk about.
I know some of the guys you worked with, and they're very happy. So,
and by the way, they're happy to take a phone call from people to talk about what they've done. But what we do is not as quite as simple as that, because what you have to do is you have to identify your QRAs. What are the activities of your shop foreman, of your order writers, if you've got a specialist in there that you're doing. We have to identify what all of those different pieces. We then match that up against, the IRS calls it the nexus, the connection between the QRAs and what they call QREs, qualified research expenditures. And I can use wages, I can use outside services like yours, Cecil, and I can use materials. Like if you created a new hoist, that you needed a new thing to fit to lift engines or whatever it is that you're doing, and you created that and you use materials, bought materials for that, those are considered those expenses. So what we have to do is we have to take the QRAs, the activities, look at that in conjunction with your P&Ls and your taxes, because we are only interested in getting cash back in your pocket. By the way, right up front, we make our money, our income comes in as a percentage of the cash you get back. This is not an exercise where I find a whole bunch of credits for you. We have to get cash back in your pocket. That's the only time we make money.
So hang on. I want to clarify, because I don't know that was clear. It is an exercise where you find R&D credits, but I don't pay you to do that. The way that I pay you to do that is when you find the R&D credits and we get cash back, you take some piece of that money I get back. Exactly. If I don't get any money back, you don't get paid.
Exactly right. Or if we go in, and I can tell you, I personally have done hundreds of these cases. We have done thousands of them as a business over the last 17 years. I do not within my business, I've never had what we do audited. We are part of an audit. I'm sure you're going to dig down into that piece of it as well. We have been parts of audits where they have looked at other things and they also looked at what we did. We're fine with that. But what does happen is that sometimes you end up with a situation, and I'm applying for, I don't know, $36,000 of refund. And the IRS says, I'm not sure about that one. We think it ought to be 32,000. We'll probably go back and forth with them. By the way, we do this at no cost to our clients. We go back and forth with them and say, okay, probably it's worthwhile just accepting the 32,000, because we could argue for years on that. So we accept the 32,000. It's a reduction on that, and we reduce our fees accordingly. Okay. I have never had a circumstance yet where they came back and said, no, we're not going to give you anything on it when you apply. Okay.
So,
because we don't want to do that. That's a waste of time for us. And we've done so many of them, we know where it's at.
So the way I understand the process is we contact you, and a meeting is set up, a exploratory meeting is set up.
Discovery, exactly right.
Where we talk about, what our people do, how much of the time they spend doing it, and we identify these QRAs.
Mm-hmm.
And then, your accounting team, your people, take a good look at all that, decide, yeah, I think this is really legit. Here's what this is going to look like.
And in conjunction with your P&Ls and your taxes. Yep.
Yeah, you got to have the right. You got to
have the
find
detail.
out.
We have to have the detail.
Well, if I didn't spend any money, so that's my mind is like,
that's right.
I'm all over the place. So let's say that I didn't earn any money that year. I lost money.
Mm-hmm.
Can I carry the credits forward?
Very, very good question. So first of all, here's the way we would look at that. Let's give an example. We can go back 3 years, that's what we can do. We can go back 3 years. And let's say that you had, for the first 2 years of that, you had a bunch of loss carry forwards, or you lost your tail in a gas investment that you made or something, whatever it was. So you ended up paying zero taxes.
Right.
Okay. That which happens, right? So you paid zero taxes, but that doesn't change the fact that you did those activities during those years.
Right.
Okay? So what ends up happening, R&D credits by law are able to be carried forward for 20 years. So what we do is we look at all 3 years going backwards. You pay no tax in 2018, no taxes in 2019, but 2020, all of a sudden now you've got a pile of taxes. What we do is we do the calculations for all of the years. They roll forward. We are able to get you money back for 2020 in our example on that. And whatever my cash you get back, we take a piece of that as our fee. If we went all 3 years and we looked at it and you just didn't have sufficient, because it is not worth anybody's while for us to go in and get $4,000, $5,000, $6,000. Okay, so we rarely do the small. But if that's the case, then it just doesn't make sense. So we do what we call a no recovery on that, and we just roll it forward to look at the future years.
Okay.
Just to give you on that specific point, just to give you criteria on this, if as a company's size, our sweet spot, I think I may have said it earlier, is between $1 million and $25 million of revenue in the company. That's what we look at. We can go down to 500,000-ish, depending on the size of the company. Combination of that with you are paying taxes, and the taxes we're talking about here, if you're a sub-S or an LLC, we're talking about your personal taxes, okay, that we're looking at. And that we're looking at say, at kind of a minimum-ish of $10,000 a year average.
Okay.
But when let me before you ask the question on that one, I want to clarify that these credits that come through your company are able to be applied as credits against your taxes wherever those taxes were paid. So, for example, you have a shop and your wife is a teacher, whatever, okay, doctor, and on her income you pay a bunch of taxes. Those taxes are also able to this credit is applied against them.
Because we're filed jointly.
Because you're filed jointly, correct.
Okay.
If you weren't filed, you're absolutely right. If you weren't filed jointly, then you wouldn't be able to take advantage of that.
So hang on, because I think this is one of the keys. it's basically on my personal taxes where the credits get applied.
As long as you have an LLC or a sub S,
okay,
or a partnership, because those are pass-through entities. Credits follow taxation, and in those kinds of entities, the revenues or the losses from your company follow forward, usually on a K1 that you're used to getting those, and so you have an income on that K1. Any W-2 income you take during the year, obviously you're paying taxes.
Well, and that's the other thing I think that we need to pay attention to here, because I may not have made money. Let's say, COVID was a tough year for some people.
Yeah, absolutely.
So I took money out of my company because I take a check and I take draws occasionally, and yet at the end of the
pay taxes on those, right?
Right. And so I'm I'm attached to those things. I like those things. And therefore I have paid taxes. Now my company at the end of the year may not have made a profit, so there's no pass through to me, but I could pass through the research and development credits and get it off of a 1-for-1, dollar-for-dollar based on the taxes I did pay on the income I did take.
Exactly, through your W-2. Remember, what I said earlier was that R&D credits don't look at the dollars as an income, income or as an expense, right? They are involved with your activities. So even if your company lost money, it doesn't matter that doesn't matter. You also did those activities which created credits.
All right. And so again, I think we're going to have some people that are going to watch us and go, wow, oh my God. Like, we were in a meeting. I was in a meeting with Richard, and there was, 12 of us or something. And there's 3 of us sitting there drooling, because we're like, oh my God, I could get 80 grand back. And moving forward, I could save $20,000, $30,000 every year in one-on-one tax credits. So there's 3 of us drooling. I think there were another 3 people in the room that were like, I don't know. This is kind of scammy. I don't know. And then there was the middle ground. There always is the middle ground where they're like, I'd like to do this, but I don't quite believe it, So I'm just an automotive shop. What specific activities would an automotive shop do that would qualify for research and development tax credit?
I'm going to give you an example that I use. That's not an automotive, and I'll get to that in a minute because I think you'll be able to tie it together. I have a client out in California, and what they do is they print labels. That's their entire business. Decent sized company, $6-8 million company, but they do labels. Their process is that they have 2,500 times a year. Somebody comes in and says, I want to put this label. I want a velvet label in chartreuse color on a twisty plastic bottle. Okay, whatever it is that they're coming in. They come in and say, I got a problem. I need to solve that problem. They say, well, all right, I'm not sure if I can do this. Not sure if you're even going to buy what I'm offering, but I'm going to spend time and I'm going to figure out what the problem is. What are my alternatives? What kind of things can I use? What kind of adhesive? What kind of coloring? What kind of materials? And I have to go through all of this and say, okay, based on all of this, this is what I think we can do. They then say yes or no. Okay. And then now, once you've done that, up to that point, you're doing trial and error. You're doing experimentation. You're trying to figure out alternatives. What are my choices? Will this go? And you're taking a risk. Because that client may say, oh, that's way too expensive. I can't do it. Okay. Right. But once you start doing, in my example, once they start that print running, because they do big runs, it's going to run for 24 hours, 2 weeks to run millions of these things. Once that starts running, no R&D. That's just doing it.
All right.
Now, so
go ahead.
The parallel. Obviously, I bet you now that
I'm already. It's going on. It's going on here, baby.
You get somebody that walks in to your office, walks up to the desk, and say, "Hey, my truck is going like this. I don't know what that is." And you say, "I don't know either." Let's find out. Now you go in, you check it, you put it on the scope. Oh, by the way, you had to learn how to use that scope, right? Because you bought this new scope.
I also had to buy the darn thing, so I could actually do the R&D.
That you can do that, exactly right. And it's not the equipment. You're going to deduct the equipment, but I'm gonna find credits because you had to learn how to use that equipment. First, you had to find out which scope you could use. I'm assuming there's multiple of them. Okay, different kind of scopes that I want. Then you had to learn it. Then you had to learn to train your people to do it. Then now you got to use it, and you're going back and forth. So how many times a year, as a auto repair, do you have people walking in and say, I got something wrong? I don't know what it is, but let's figure it out. Now you got to figure that out. Or they even walk in for service, and now you're saying, oh my gosh, there is something going on here. I need to figure this out. Okay.
So let me see if I can make a couple of direct applications, and you can tell me whether I'm going down the right road or the wrong road. In my business, my personal automotive shop that I used to run, each of our technicians got 48 hours worth of training every year. 48.
Did they use computers to do that?
Absolutely.
Did they use the internet?
Yeah. They did. They also went to physical classes where they learned how to use certain tools and diagnose certain things, etc. And so the way that I look at that, if I paid those guys on average, say $50 an hour, and there were 5 of them that work 48 hours, I've just found $12,000 worth of tax credits. Okay.
You found $12,000 worth of QREs, not the credits. Yeah. You've got those are expenditures for your activities. Okay. Yes.
All right. Now I also have my diagnostic person. Customer comes in with a vehicle that says, you go down the road and about 35 miles an hour, the car goes vroom, 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 vroom. Okay. We have no idea what's going on. So my diag guy takes the car out, experiences the problem, hooks up the equipment, spends whatever time to figure out what's wrong with the vehicle. All right. And then he has to communicate the plan, write up the plan for the service advisor, who then writes up the plan for the customer. Up to this point, that is R&D.
Exactly right. And let me go very, very specific on that. You've got a diag guy, and I've hit this many, many times with the shops that I've worked with. You've got a diag guy, and that's all he does. He diags all day long, figures it out. He handles one of the shop people and he's got an additional problem, and he says, "Look, George, I don't know what this is. Can you help me figure it out?" If he spends 80% or more of his time, the IRS says that's their 80% rule. You can use 100% of their income as R&D expenditures.
I'm just getting more excited.
It's their rules. It's their rules. We just apply them.
So again, I'm going to look at my shop. I have my guy. My guy creates the plan. Then he gives it to my service advisor, who then does the pricing, pulls all the pieces together, presents the plan to the customer. This is what we would like to do. This is how we're going to solve your problem, et cetera, et cetera. Does the service advisor's time also count in that?
A piece of it, not as much as your diag guy.
Okay.
But a good piece of what he's doing. I mean, he's obviously taking phone calls and he's calming down Mrs. Jones, who wants her car now and you just can't get to it, or whatever it might be. So there's going to be a lesser piece of time.
Yeah. But I mean, but if you looked at the typical service advisor, there is 10, 15, maybe 20% of that person's time that is in estimating and figuring out what the plan is, et cetera. So now you're not talking about 80% rule. You're really talking about 20% of
exactly.
But if I'm paying somebody $100,000 a year and I can say 20% of his time was done in these very specific ways, then I've got my QRAs. And now it looks like, and then you're able to go back 3 years.
Exactly.
So if we identify, let's say we had the same employees for over the whole 3-year period, and we identified that this technician spends 80% of his time diagnosing, this technician spends 40% of his time diagnosing, and this service advisor does 20% of their time, blah, 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 then we would take 100% of this guy, we would take 40% of this guy, 20% of the other guy, and put all that in a pile and say that it qualifies as a QRA.
Exactly right. And I'm going to go down a little bit into the weeds with you, just so that you got some understanding. That, what you're discussing right there, is the fundamental change that happened with R&D in the early to mid 2000s. Okay, for the first 25 years, as I said early on, this was just big company stuff. And by the way, go on the internet and Google R&D tax credits. You'll get millions of hits and lots of companies.
Yeah, I know you sent me about 8 different things. So
right, I tried to, more than you ever wanted to know about R&D credits, right? Exactly.
I want you to know about R&D credits. That's what I want.
And I want you to know that I know. So,
that's right.
So the point that I'm making is that all of that time, for 25 plus years, it was only the big guys, only C corporations. LLCs didn't even exist, and sub-S corporations weren't very popular, and they weren't used. In the early 2000s, under the Bush administration, all of it now, LLCs now were allowed to take advantage of this. And there was another methodology which was created specifically because small to mid-sized businesses do not have the detailed line-by-line credit of documentation of what those QRAs are. I can tell you the big guys do, because they've got Deloitte,
because they know how many billions of dollars it's worth to them.
Exactly right. And I'll give you one example on that one that I used. We've all probably saw in 2018 that Amazon paid zero in taxes, right? Zero. A little bit irritating to me that Amazon paid less in taxes than I did, but that's a different discussion. But they paid zero in taxes. One of the reasons that they paid zero in taxes was that they had $437 million worth of R&D credits, dollar for dollar reduction. If they had not had those $437 million, they would have paid $437 million directly to the government. Okay? The same laws that apply to Amazon applies to Fred's Auto Repair. Okay. Same laws. You just have to know how to apply them.
So now let me take another scenario here, because I want the people that are going to listen to this, watch this, and hear this. I want them to understand how it could possibly potentially apply to them. Mm-hmm. All right. So now I'm a shop owner, and I'm going to go away for 2 days to a meeting with other shop owners to help plan my business, to learn things about my business and create a business plan or a marketing plan or something so that I can take my business forward.
Yep.
Are those QRAs?
Those are part of those are. Okay. This is where we get into, and this is where I was going with it, is that one of the fundamental changes that was made was that instead of having to have line items, you were able to estimate the percentage of the company, or you specifically, or your diag guy, you estimate that as the subject matter expert. That was tested in court, and specifically because small to mid-sized businesses weren't able to take advantage of it, because they're building their widgets, they're fixing their cars, right? They're doing what they need to do. They don't have all of this detail that an Amazon has. The court said that's not fair. So we need to make a methodology. So they created a methodology by which the subject matter expert can identify the percentage of the company. That's what I do specifically. I sit on a Zoom call because I work nationally, and I sit on a Zoom call with the subject matter expert, maybe one or two in the company, and we walk through the company to identify and come up with those percentages. That's the process. Once we have those QRAs, that kind of percentage, then the our CPAs that do this, we then apply those activities against the actual expenses that are reported through your P&Ls and your taxes.
Okay, I have another question in my mind that has nothing to do with automotive necessarily. It's more to my company. I have a software engineer. They're building Cecil comes up with a wild idea that he'd like to see certain numbers and have it kind of be interactive with the numbers to be able to tell the shop owner, you have a problem here, and here's where we need you to go so you can fix that problem. So He spends a year and a half of his time, literally 90% of his time for a year and a half, developing whatever this software is going to be. We buy a company that already has that. It's already there. They had it developed before I bought them. Now we buy the company. We have this thing. I don't need that anymore. We put him on other projects, but for a year and a half, that's what he did. Are those QRAs?
Very good question. And the answer is yes, because the IRS doesn't care whether you make money, lose money, or whether you're doing. What they care about are the activities.
Yeah, the action.
Right.
Yeah.
Remember, I'm not looking at dollars. That, as a matter of fact, that printing company that I was telling you about, that I used as an example, they actually had an application for a unique thing that they're doing. Basically, it was 3D printing. Okay, and they spent over $150,000 in hard cash to attorneys and all the engineers and all the people, plus all of their time internally applying for this patent.
Okay.
It got turned down. It doesn't work. It was a complete failure. Okay, but that's an R&D. That's an activity. That's the risk. The IRS, the concept behind R&D credits is that we as business owners are doing these activities. By the way, it has to be technological in nature, which is why auto repair fits so well. You guys use software, you guys use hardware, you guys are technological in nature. But the whole purpose of this is to encourage innovation, experimentation, testing, finding something new, making something better. And what they're saying is, hey guys, if you take this risk, we'll give you credits for this that you can use. And the way they do it is they use it against the taxes. Okay. So it's what their whole thing they're trying to do is encourage companies to do this. And that's the way that they're encouraging it. With your big boys, with your other people, they're trying to keep you in the United States.
Yeah.
California has a huge R&D program. They're trying to keep you in California because we all know everybody's moving out of
California. Going to Texas.
Right?
Going to Texas and Florida.
Because Texas doesn't have it. But Texas, honestly, what I really like is that I get to reward business owners for doing things that we all want our business owners to do. We don't want them to sit back and be complacent. We want them to grow. We want them to make more money. We want them to be profitable. We want them to hire more people, right? I mean, that's what we all want to do. It helps our economy. This is a way that the government is saying, yep, that's what we put these things out there for. We'd like to help you take advantage of it.
So I'm one more scenario, and then we'll talk about a couple of other things. I've got my marketing person. Yep. We sit down, and that marketing person goes online, figures out, are we going to use this technology or that technology? How are we going to get our message out with the idea of driving our business, making our business better, improving our business? So we're creating some kind of a marketing plan. Some percentage of their job is to create that plan. And I would say that the creation is the monitoring of whether or not the plan's successful probably isn't, but certainly the time creating the plan and all of that would be QRA time.
Think website.
Yeah.
Think website development. Okay.
Right.
You are creating a website in order to make your company better. What's it going to look like? What colors are you going to use? What message do you want to have?
So even the branding stuff, the graphics, the coloring, all of that. Mm-hmm. Holy smokes! So that I'm going to be rich.
We don't ever let you overstep because our interests are aligned, Cecil. As a company, we want you to get the most you can possibly get.
Right. Because
we get a piece of what you get. So
I don't want to do something that would put me at jeopardy. So I expect you to tell me, Cecil, right. This is not.
Exactly.
Okay? And that's what you guys do. That's
what we do. Yeah. Because we're aligned. We want you to get the most you can because we make the most money. But we are responsible for any issues or problems.
So if I have a regular planning session for my business, if I have a marketing team that I work with who decide the color and the branding, how the thing's going to look, where it's going to go, etc. Then I have, and if I have a diagnostic person who's figuring out, or even, all of my techs were kind of diagnostic, but I didn't have one guy that did all the diagnostic. I had all of my techs spent some portion of their time figuring out what was wrong with the car, figuring a plan to move forward, and then they actually did whatever the repair is. So the QRA is the figuring time, the diagnostic time, the educational time, but the time fixing the car itself is not. And I find this very interesting because if you go back, I started my career in 1979 as a technician. And back in 1979, we weren't, diagnostics was a very small part of our business. Okay. And actually repairing the car was the biggest part. You could see that the water pump was leaking without tearing the whole car apart just to figure out what's really going on. There weren't a lot of electronics, so you didn't have to, it wasn't that overly complicated. And so you spent 10% of your time diagnosing and 90% of your time fixing, right? Nowadays with automotive, the vehicles are so sophisticated, you might spend 50 or 60% of your time diagnosing, figuring the plan out, and 40% of your time actually fixing the vehicle. It has changed so dramatically in the past 15 years, 20 years, that it really sets the business up for more QRAs, more available.
You're absolutely right. It does, and that's a shift, the change. And you are becoming more and more technological as you go.
Oh yeah, it's got
software. You guys are literally programming some stuff, right?
Yes.
Yes. Right. I'm gonna do it. We talked about the programming. You talked about having your software. I'm gonna change my background for just a second, just for giggles and grins.
Oh, cool.
Okay, that's a different background. And I had it up. We are endorsed by the Microsoft Channel Partners Association. This is thousands of tech companies across the United States, all of whom are doing the same type of stuff you're talking about. So yeah, it's a huge interest to us. This is a huge interest to them for all of exactly the same reasons.
Okay. All right. So let me ask you another. I'm going to ask you a couple more questions, and we'll let you go. You and I have our meeting tomorrow. I can't wait. Why business group resources? Why not the other 6 or 8 or 10 guys that are out there doing this?
Absolutely, and believe me, it's a lot more than 6 or 8 or 10. There are literally hundreds. Here's the fundamental. Sorry, go ahead.
The funny thing, I just got to mention this. You go out and you buy a white Ford Explorer, and before you buy it, you don't see any white Ford Explorers, but the minute you own it, there's like 10 of them on the road the first time you drive it. I have run across 3 other companies that do this since talking to you. And
because you notice it.
Yeah, before talking to you, I was completely unaware of any of this. So I'll let you answer the question.
Yeah, no.
Why you guys?
Why us as opposed to the others? Well, I've got a paper. We do, as I said, we do a lot of work with CPAs, and one of the papers that I've got that was actually created for them is a history of R&D credits and why we are different. Okay, because like I said, there are piles of companies that do R&D. However, they do R&D. Our focus is that small to mid-sized company. I just had one where I was actually talking with another R&D company, and they wouldn't look at anything unless it was $500,000 or more of QREs. Okay, that's just what they do. When we started the company, we did it specifically for small to mid-sized businesses. As a result of that, and we've been doing this for now 17 years now. So as a result of our focus being there, we had to make process systems software such that it worked for Tracy in Northern California that's running a shop, right? And he doesn't have the opportunity to have all of this sophistication. So we had to figure out how to make it work. Among the things that we did to make it work is we created and we utilize a contingency basis. We don't make money unless you make money. We look at a company and decide whether or not we've got dollars coming back to you with no cost whatsoever. It doesn't matter to us what work we have to do up front. If we don't have money for you, then there's no cost. We'll just
forget it. It's no good for anybody. Okay.
Right, but we had to go through.
But you've had your time in.
But we had to figure that out.
But you're doing your R&D.
Exactly, without getting paid.
Yeah.
Go find another CPA that's going to analyze your business and spend hours analyzing your business and comes back and says, you don't have anything, so you don't have to pay me.
Yeah.
Right?
No. My guy's $450 an hour, so
exactly.
It is what it is.
Exactly right. So we did that. We created our own software internally to make it easy. We created the process by which I sit down for about 2 hours. It takes me about 2 hours to analyze it, to work with and analyze a company. And when you go through the process, you'll see it. I always have people set aside 2 hours. I'm usually able to get it done in an hour and a half. But we go through and analyze it. But that's the totality of it. That plus giving us your P&Ls and your R&D and your taxes, we make it easy for you to do it, right? Because over the years, we've done this so many times, we've got our process down. We have internal guidelines because we know the IRS and we know that a company that has X amount of revenues, that's in X industry, that has X amount of expenses, is somewhere between this. I call them goalposts. They've got a fancy name for it, something equilibrium. I call it goalposts. We don't want you to be outside that goalpost. Okay, you can be low, but you can't be high, because that's when we're both going to end up having to do work for the IRS to go check this stuff out. So all of these things, this is all pointing back to why us. Our focus is on you, your owners, your shareholders, because if you don't get money back, we don't make any. So if you get in problems, we have problems. We work together on that. So we try to work that out, and we made the process easy. We don't have somebody coming in at $450 an hour and tearing apart your books and sitting there taking your people for 12 hours, because you, as a small business, can't do that. You don't have the resources.
So I got three things now. It was only two before, now it's three. I'm a business owner who wants to expand my business, so I have to develop a plan to go out and buy this other piece of property, here's how we're going to build it, here's what it's going to look like, here's where the pumps are going to go, and all of that. QRA, right? Pieces of that,
parts of it. Yes, okay. Absolutely. Yeah. All right. That's one of the questions that we ask.
Okay, so let's get maybe the elephant in the room out a little bit. What percentage do you take of the money I would get back?
The typical percentage that we take, and I say typical because if it gets very large, gets over $250,000, and I have had my largest last year was $605,000 recovery, not for an auto company, but was recovery. Our typical fee structure is 33% of the cash you get back.
If I don't get anything back, I'm not paying you.
We got zero.
And the more I get back, I'm paying you 33% of whatever I get back.
Exactly.
Okay. Now, and the way I see it is 33% of nothing is nothing. But let's say that it's $100,000, mm-hmm. and I'm going to pay you $33,000 out of that $100,000, I'm still getting $67,000 back that I did not know I was going to get, nor did I ever think I was going to get it. So for me, it's a no-brainer.
It is truly found money. That's why I started this out. What's the value of it? We give cash to companies.
Well, if you're a typical small business person and you find $50,000 that you can pull back in your company and use in other ways, or hell, I want to buy a boat, whatever.
It's your money to decide with what you want to do.
Right.
Yeah.
So. But I didn't have the money before. Now I have the money. I'll take whatever I can get, frankly. The last thing that I'm going to ask you, I think, and then we'll wrap this up, is should I, as a business owner, after you and I get through with all of this, should I then try to define some of this a little better moving forward, or?
Oh yes. Well, I'll tell you what. Here's what my experience is, and literally, hundreds of times that I do. When I walk through this process with you, I walk through and analyze your company, okay, with you as we're walking through. I've had people say, "My goodness, I've never looked at a company. I looked at my company like that." I've got my background in business school and I ran businesses all my life. So this is really fun stuff for me. I enjoy it.
Yeah, some of us are a little twisted in the head. So we enjoy certain things.
Right? So the answer is, when we walk through, by the time we finish that hour and a half to 2 hours, you will know what I'm looking for. Matter of fact, halfway through, you'll start telling me, "Oh, we did this." Right. And then this. I see. What I'm looking for when I do this analysis with you, I'm looking for two things. I'm looking at what you do on a day-to-day basis. How many people do you? How many cars do you look at? What does your service manager do? What does your techs do, etc. I'm looking at day-to-day. I'm also looking at projects. And I'm going to ask you about what kind of projects you did. Your example, Cecil, where you talked about your guy that was creating the software to do something, and then it all fell apart because you didn't need it anymore. That's a project. So I'm going to I'm going to submit all of that stuff to the CPAs, along with our decision as to what the percentage of the company is, and let them look at it. Okay.
Holy smokes, because I'm paying somebody $60,000, $70,000 a year to do this, and I would say 90% or more of his time was spent on this.
Of course.
And those would all be, well, you and I are going to talk about it, but in my mind, those are all qualifying because that's what we were doing.
And that's what we document.
And then
put it together, and that's when we give it to the CPAs and let them do their magic.
One more personal thing, and that is, I spend a lot of my time building business plans for shop owners. So we go out to the business, we review what's going on, we look at their financials, we discuss their profits and losses and things like that. We look at the facility, we go online and we check marketing, demographics, all of that kind of stuff. And then we come back, and I spend 4 days to a week putting a plan together for the shop owner. We call this our business success plan. Mm-hmm. That seems to me like it would qualify as a QRA.
As long as we've got technology running through that.
I have spreadsheets and all kinds of stuff that I use.
Exactly. What we would do is we would identify that as a project for Tracy in Northern California, looking at his.
Actually, we did one for Tracy. So actually, that's absolutely true. So
okay, that's great. And we'd look at that, and that would be a project that I would ask Tracy about, and I'd say, how many hours did you spend? How much money did you spend on Cecil? What did you do for this? Okay, along with did you do a new website? What was that? Talk to me about how that was doing.
What did it cost you? Right.
Yeah. Right. What did it cost you, and what did it cost you in time? I've had people tell me, it cost me $10,000, to put that as that. I said, how much time did you spend? Oh crap. I
50 hours, 60 hours.
Days working with this thing and going back and checking it. But people don't think about that. Just like they tell me, you know what? I got money back in my taxes last year. I got $5,000 back. I didn't pay any taxes. And I say, well, hang on.
Yeah. No. You paid taxes. You only
got
$5,000.
You only got $5,000 back because
you paid $70,000 and you got $5,000 back.
Exactly right. So no. Let's look at this. You got to look at the reality of what it is. This is the world I live in. I live and breathe financial statements, so that's what I do. So that's what we bring to helping identify this specific niche market, so you guys can become part of the $14 billion that they're spending. We'll make it $15 billion. Okay.
Yeah. I want my billion.
What's a billion?
I want my billion. That's fine. That's all I need. All right. I can't think of anything else to ask you at this point.
Yeah, I do want to. I want to go back. I do want to go back because I want to make sure that we've hit those 3 big points. One, One is this for real? And I say, I'll send you the stuff. We talked about that. Two, why didn't my CPA tell me about it? I think we've talked about that in spades. It's just not, it's not a detail that they work with. Three, am I going to get audited? I do want to address that just very specifically. Again, I told you that in my history, I have never had the IRS or state entity come back and audit what we've done. I've had them ask plenty of questions, and this goes to the CPA firm. I don't do it myself. But they've had plenty of questions. I've had them reduce it somewhat. They've never had an audit, and I want to explain why I believe that we don't have that at all. And that is because the pat answer, the easy answer is, oh, we know what we're doing. We've done it for 17 years. We've got software. It all works. We know it. That's one piece. The big deal here is that 98% of what we do is done retroactively, meaning you have already paid your taxes. An audit is when a taxpayer takes a deduction or a reduction of the taxes he's going to pay and doesn't pay the taxes to the IRS. $37,000 coming back to Cecil for 2019, okay? And they look at it and says, I wonder what that is. I'm not sure. I want to go check. I'm going to send one of my people in the field out there. That's an audit. But what we do is we say, Cecil should have never paid that $37,000 in 2018, and here's why. If they've got questions, they come back and ask them. If they've got any issues, they come back. We discuss the amounts. If they want to reduce it, we do that. None of that's an audit. That's just working through the figures.
The way I would case it is this: it's approved by the IRS, or nothing comes back. So once they've approved it, said yes, these are legitimate. We believe these to be legitimate. So here's your money coming back. They can't go back on it because they're the ones that literally.
Well, I want to say first, I want to make it very clear: the IRS can do whatever the hell they damn want, please, right?
Yeah.
So if they want to pay it and then come back at it, they could do that. We don't have that. It hasn't happened. And my personal belief, and this is a personal belief, I'm not giving you accounting advice in this, but this is to me, there's no reason. Why would they? They've already looked at it. They paid you the money back. You've got a three-year look back. They can't go back any more than 3 years. I think it reduces the probabilities, a long way.
And then do you so I'm looking for the big payday. 3 years. I'm looking for 100 grand, 120 grand, whatever. I don't know what it'll be. You and I are going to talk, but that's the big payday. But then moving forward, I want to be able to get my 20 next year, my 20 the year after, the year after that. So you still continue to work with the companies to maximize this. That's the beauty.
Forward. That's the beauty of this for both of us. Okay, we want you to do it. It becomes easier. Obviously, we have all of our documentation for the first year, but still, hey, I'll buy a lunch and we'll figure out what we need. We can both have it over Zoom, right? Because you're in Nebraska or wherever you are on this. But yeah, that's exactly what we do. Because we have a 3-year look back, we can do it year by year by year. If we decide, for whatever reason, we want to skip a couple of years and then go backwards, we can still do that. We haven't lost anything because we've got the 3-year look back. Okay. So we end up. I try to stay in contact, obviously, and then we if you've got any issues, questions, or problems, we always are available for it. But yeah, we're going to reach out to you and say, all right, time to look at it again. You ready to do now? You say, yeah, you know what? I just do this. And we'll work it out. We just figure out what's right for you as a company.
All right, Richard. I think I got you. You said I couldn't make it last an hour. I think I did. It goes really quickly, doesn't it? How about that? Thank you for being here. Thank you for giving me an opportunity to give this to my clients and other automotive shops that deserve these credits. Those of you that are watching this, if you have any questions, I see Richard's phone number has been up there the whole time. I have talked to him more than once, and also his email is there.
Email's there.
And he's been very open with me, answered all kinds of crazy questions because I always have them. If you saw this on the leading edge, let Richard know. Hey, I saw you on the leading edge, and I don't know, we'll do something special for you. All right, Richard, thank you very much. Those of you that are watching, if you like this or you got information from this, please like it and share it within your groups, because we want to get this out to as many shop owners as possible. I know that you have one guy who you found 50 grand for. If you can do that for him, you can do that for almost anybody else. Is there one more question? I got to ask it, and then we'll. Is there like a bot? Is it like 5 grand or less that you're going to say no, or is it 10 grand or less? What's the bottom line?
You know what? I have seen them come in as low as 5 or 6 or 7 grand, but that's probably because we've already done the work and we figure we may as well. Okay.
Make a couple of bucks and
make a couple bucks.
He makes some bucks.
We've already done the work. What the hell, right? So on that, but again, looking at the numbers from a company standpoint, you want to look at a $500,000 revenue plus, and you paid taxes. Meaning your personal taxes, and around 10 grand, could be 8 grand average over the last 3 years. Okay. If you paid 8 grand average over the last 3 years, then you're at about 25 grand. We're not going to get it all back for you, but we might get 10 or 15 grand of it. You know,
I have paid so much more than that. All right, guys.
That's a good problem.
Richard, thank you so much for your time.
Thank you very much.
And I will be talking to you tomorrow.
Tomorrow, I think it's 2 o'clock.
And by the way, if you have any questions or anything, you can hit up Richard. We will be monitoring the chat as this is playing. So if you have questions, you can ask us. And again, just thank you. See you later. See you next time on the
Take care, guys. Look forward to talking to all of you. You take care now.